Ladies and gentlemen, what if I told you that 90% of gold investors are watching the wrong clock? While most traders focus on London and New York, a critical part of gold's daily price discovery often begins hours earlier in Singapore. Even Jamie Dimon has emphasized that global capital moves where liquidity and opportunity exist, not where investors are looking. Today, we'll uncover why the Singapore session has become increasingly important, how it influences gold before Western markets even open, and what smart investors can learn from this overlooked window. If you own gold or are thinking about buying it, this is information you don't want to miss. For decades, many investors have instinctively focused on the opening bells of London and New York, believing those sessions alone determine the direction of gold prices. That perspective made sense when the financial world revolved around a handful of Western markets, but the global economy has changed dramatically. Today, capital moves continuously across time zones, and the gold market reflects that evolution. One of the most significant yet frequently overlooked developments is the growing importance of the Singapore trading session. Ignoring this part of the trading day means overlooking a market where physical demand, institutional positioning, and regional sentiment begin shaping price action long before Western markets become active. Gold is unique because it is not simply another commodity. It is simultaneously a monetary asset, a store of wealth, an industrial input, and a hedge against uncertainty. Because of that, its value is influenced by a broad range of participants spread across the globe. Central banks, bullion dealers, refiners, jewelry manufacturers, sovereign wealth funds, hedge funds, and individual investors all participate in the market. These participants are not concentrated in one region. They operate across continents, meaning price discovery has become increasingly global rather than regional. The Asian trading hours deserve attention because they coincide with some of the world's largest consumers of physical gold. Unlike speculative futures markets, physical demand represents real buying and selling of metal. When refiners require additional supply, manufacturers repair inventory, or investors increase allocations to precious metals, those transactions create genuine market signals. These signals often emerge before Europe and North America begin their trading day, providing valuable insight into underlying market sentiment. Singapore has gradually established itself as one of the world's leading precious metals hubs. This transformation did not occur overnight. It developed through years of investment in financial infrastructure, transparent regulation, secure vaulting facilities, and an efficient trading environment. These characteristics have attracted international banks, bullion dealers, institutional investors, and storage providers seeking a reliable gateway to Asian markets. As liquidity has increased, the city has become an increasingly influential center where global participants interact during Asian hours. Liquidity is an important concept because markets function most efficiently when buyers and sellers can transact easily. As liquidity grows, price movements become more meaningful because they reflect the decisions of a larger number of market participants rather than isolated transactions. Increased participation during the Singapore session means that price changes occurring during these hours cannot simply be dismissed as overnight volatility. Instead, they often represent genuine shifts in market expectations. Another important factor is the changing balance of global wealth. Over the past several decades, economic growth throughout Asia has expanded significantly. Rising incomes, increasing investment activity, and expanding financial markets have naturally increased participation in precious metals. Gold has long held cultural and financial significance throughout many Asian economies, making regional demand an important component of the global market. As wealth grows, investment decisions made during Asian trading hours carry increasing influence over worldwide price discovery. Technology has also transformed how markets operate. Financial information now moves instantly across the globe, allowing institutions to respond within seconds to economic developments. Markets no longer wait for one financial center to close before another begins making decisions. Instead, investors monitor developments around the clock, adjusting positions whenever new information becomes available. This continuous flow of capital means that significant price movements can originate during any major trading session. Institutional investors recognize this reality because they operate on a global scale. Their trading desks monitor activity throughout the entire 24-hour cycle rather than focusing exclusively on one region. Professional market participants understand that valuable information often appears during Asian hours. Observing volume, price behavior, and physical demand during the Singapore session can provide early indications about how markets may behave later when European and North American traders enter. This does not mean every movement during Asian trading will determine the day's final direction. Markets remain dynamic and new information can emerge at any time. Economic reports, central bank announcements, geopolitical developments, and changes in investor sentiment can all influence prices later in the day. However, understanding where early momentum originates provides investors with a broader framework. Instead of relying solely on Western market activity, physical gold demand often behaves differently from speculative trading. Futures markets may react rapidly to short-term news, while physical buyers frequently base decisions on longer-term considerations such as wealth preservation, inventory management, or strategic diversification. When physical buying strengthens during Asian hours, it may indicate underlying demand that extends beyond temporary market fluctuations. Investors who observe these patterns gain additional perspective on whether price movements are supported by genuine buying interest. Another reason this trading session matters is that global supply chains increasingly connect producers, refiners, distributors, and investors across multiple continents. Gold mined in one region may be refined in another and ultimately stored or sold somewhere else. These interconnected relationships mean that market activity during Asian hours often reflects broader developments occurring throughout the international precious metals industry. Long-term investors benefit from appreciating these structural changes rather than becoming distracted by every short-term price movement. Successful precious metals investing has never depended solely on predicting tomorrow's price. It depends on understanding the broader forces shaping the market over years rather than days. The evolution of Singapore into an important trading hub represents one of those structural developments that deserves careful attention. Ultimately, the gold market no longer revolves around a single financial center. It has become a truly global marketplace where meaningful price discovery occurs continuously as trading moves from one region to another. Investors who recognize this changing landscape place themselves in a stronger position to interpret market behavior with greater context. Watching only London and New York provides an incomplete picture. Understanding what happens during the Singapore session offers a more comprehensive view of how global capital, physical demand, and institutional participation combine to influence one of the world's most important monetary assets. One of the biggest mistakes investors make is assuming that money moves according to political borders or financial traditions. In reality, capital has always been drawn toward opportunity. It seeks stability when uncertainty rises, growth when economies expand, and safety when risks increase. Markets evolve because investors constantly reassess where the best opportunity exists, and those decisions reshape the financial landscape over time. This is an important concept to understand when analyzing the gold market because the forces driving precious metals are no longer confined to a handful of Western financial centers. Instead, they reflect a much broader global network of investment activity. Financial markets today operate in a completely different environment than they did several decades ago. Advances in technology, faster communication, and increasingly interconnected economies have allowed money to move across continents almost instantly. Large institutional investors are no longer restricted by geography. Pension funds, sovereign wealth funds, central banks, multinational corporations, and investment firms allocate capital wherever they believe the balance between risk and reward is most favorable. This shift has fundamentally changed how global assets, including gold, are priced and traded. When professional investors evaluate opportunities, they rarely ask where a market is located. Instead, they ask whether that market offers liquidity, transparency, efficient infrastructure, and access to participants who can facilitate large transactions. Those qualities determine whether capital is comfortable operating within a financial center. Geography matters far less than the confidence investors have in the systems supporting that market. This broader perspective helps explain why financial influence is becoming more diversified. Economic growth over the past several decades has expanded well beyond traditional financial capitals. Emerging economies have strengthened their banking systems, developed sophisticated exchanges, improved regulatory environments, and attracted increasing international investment. As these financial ecosystems mature, they naturally become more significant in global capital allocation. Gold reflects these developments because it is both a financial asset and a monetary reserve. Investors purchase gold for many different reasons. Some view it as protection against inflation. Others see it as insurance during periods of geopolitical uncertainty or financial instability. Central banks often regard it as a long-term reserve asset that helps diversify national holdings. These motivations exist across every region of the world, making gold one of the most internationally traded assets in existence. Institutional investors understand that meaningful information can emerge from any major financial center. They monitor activity continuously because capital flows rarely stop when one market closes. Instead, trading transitions smoothly across time zones, with different regions contributing new information, new liquidity, and new investment decisions throughout the day. This continuous process means that investors who focus exclusively on one geographic region may overlook important developments occurring elsewhere. Another important consideration is diversification. Professional portfolio managers rarely concentrate their investments in a single country or financial market. They spread capital across multiple regions to reduce exposure to localized economic risks. This philosophy naturally increases international capital flows and reinforces the importance of monitoring global market activity rather than relying solely on domestic indicators. The gold market demonstrates this principle particularly well because demand originates from many different sources simultaneously. Jewelry manufacturers, industrial users, private investors, bullion dealers, financial institutions, and central banks all participate in the market. Their motivations differ, but together they create a complex system where prices reflect worldwide activity rather than the actions of any single country. Economic cycles also vary from region to region. While one economy may experience slower growth, another may be expanding rapidly. Interest rate policies, inflation expectations, currency movements, and fiscal decisions often differ significantly across countries. As a result, investors continually evaluate where opportunities are improving and where risks are increasing. Capital naturally adjusts in response to these changing conditions. This dynamic is especially relevant during periods of uncertainty. History shows that investors become increasingly selective when financial conditions become more volatile. They prioritize quality assets, strong financial systems, and markets capable of supporting large-scale transactions. Gold frequently attracts attention during these periods because it has maintained its role as a monetary asset for thousands of years. Its appeal is not dependent on the performance of any single economy, currency, or government. Long-term investors should recognize that financial leadership evolves gradually rather than suddenly. Markets rarely experience dramatic shifts overnight. Instead, influence develops through consistent improvements in infrastructure, expanding participation, increasing liquidity, and growing investor confidence. These structural changes often unfold over decades, making them easy to overlook when focusing only on short-term market movements. This is why successful investing requires patience and perspective. Daily headlines often emphasize immediate events, but enduring investment trends usually emerge from larger structural developments. Understanding how global capital reallocates over time provides a more durable framework than reacting to every short-term fluctuation in prices or market sentiment. Another valuable lesson is that financial markets reward adaptability. Investors who remain committed to outdated assumptions may struggle as global conditions evolve. Markets are constantly incorporating new information, and successful participants adjust their understanding accordingly. Remaining open to these structural shifts allows investors to make decisions based on current realities instead of historical expectations. For gold investors, this means recognizing that price discovery increasingly reflects worldwide participation rather than activity from one or two financial centers. The market responds to a broad spectrum of economic signals, institutional decisions, and physical demand originating from multiple regions simultaneously. Appreciating this broader perspective improves an investor's ability to interpret market behavior within its full global context. Ultimately, capital does not recognize borders in the way people often imagine. It responds to confidence, opportunity, stability, and efficiency. Those characteristics attract investment regardless of geography. As the global financial system continues evolving, investors who understand these underlying forces are better equipped to recognize meaningful trends while avoiding the limitations of a narrow regional perspective. In the precious metals market, this broader understanding provides valuable insight into why global participation has become increasingly important and why observing worldwide capital flows offers a more complete picture of gold's long-term direction. For long-term gold investors, the changing structure of the global market carries an important lesson. Success is no longer about watching a single financial center or reacting to the latest headline. It is about understanding how the market functions as a continuous, interconnected system. Gold trades nearly 24 hours a day because demand exists around the world, and every major trading session contributes to the ongoing process of price discovery. Investors who recognize this broader picture gain a significant advantage because they are viewing the market through a wider lens rather than focusing on isolated moments in time. One of the greatest challenges in precious metals investing is separating meaningful trends from daily market noise. Gold prices fluctuate for countless reasons. Economic reports, interest rate expectations, currency movements, geopolitical developments, and investor sentiment can all influence short-term price action. These movements often attract attention because they are immediate and highly visible. However, experienced investors understand that lasting trends usually develop beneath the surface, driven by broader economic forces that unfold gradually over months and years. This is why perspective matters. Looking only at price changes without understanding what is driving them can lead to emotional decision-making. Investors who react impulsively to every rally or decline often find themselves buying after enthusiasm has already peaked or selling when temporary fear dominates the market. Maintaining a disciplined approach requires understanding the broader environment rather than becoming distracted by every short-term fluctuation. Another valuable lesson is recognizing the difference between speculation and investment. Speculators generally focus on capturing short-term price movements, sometimes holding positions for only hours or days. Their decisions are often influenced by technical indicators, momentum, and market sentiment. Long-term investors, however, concentrate on preserving purchasing power and protecting wealth over extended periods. Their decisions are based on economic fundamentals rather than daily volatility. Gold has historically served a unique role because it functions differently from most financial assets. It does not depend on corporate earnings, government tax revenue, or the promise of future cash flows. Instead, its value is rooted in scarcity, durability, global acceptance, and its long history as a monetary asset. These characteristics make it attractive during periods when confidence in other financial assets becomes uncertain. For investors, this means avoiding the temptation to judge gold solely by its short-term performance. Every asset experiences periods of strength and weakness. Markets move in cycles, and gold is no exception. There are times when optimism surrounding economic growth encourages investors toward risk assets, reducing demand for defensive investments. At other times, economic uncertainty increases interest in wealth preservation, supporting stronger demand for precious metals. Understanding these cycles helps investors maintain realistic expectations. Diversification remains another key principle. Gold should not necessarily be viewed as a replacement for every other investment, but rather as one component of a balanced portfolio. Different asset classes perform well under different economic conditions. Holding a diversified mix of investments can help reduce overall portfolio volatility while improving long-term financial resilience. Gold's historical tendency to behave differently from many traditional financial assets makes it valuable as part of a broader investment strategy. Investors should also appreciate the importance of patience. Financial markets often test conviction. Prices rarely move in straight lines, even when long-term fundamentals remain favorable. Temporary setbacks are a normal part of investing. Those who maintain discipline and focus on underlying economic conditions rather than daily headlines are generally better positioned to navigate periods of uncertainty. Understanding global participation also encourages investors to think beyond domestic news. Economic developments occurring in one country rarely tell the entire story. Inflation trends, monetary policy, currency fluctuations, international trade, sovereign debt levels, and central bank activity all influence gold demand worldwide. Because these factors vary across regions, investors benefit from following global developments rather